Welcome to our very first interactive session. In this homework problem, we'll get the chance to take all of our learnings from the prior section on understanding financial statements and apply them into these Excel files. So as you can see, we have a starting file, which is available for you to download, where we have the three financial statements under the cash basis, and then the three financial statements again, this time under the accrual basis. So I'm gonna now describe 5 examples, and with each example, I want you to record how exactly our financial statements will be impacted under both the cash basis as well as the accrual basis. So let's begin with example number 1. The company sells a $12,000 annual subscription in January, and the customer paid upfront in full in the same month. So let's go over how exactly this would be impacted under the cash basis. Well, the cash basis, like we said, is really simple. The company received $12,000 in cash, so we record $12,000 in income from this sale. We now have $12,000 in net income, absent any other expenses, and our balance sheet will show a $12,000 amount in retained earnings. Now, absent anything else, our cash will also be $12,000, as we can see on the statement of cash flows. We received $12,000 from net income, no changes in our balance sheet, hence our ending cash is $12,000. The accrual basis is a little bit different. In this case, this is an annual subscription. So instead of recording $12,000 all up front, we're only going to record $1,000, or rather 1/12 each month. So I'm going to come in over here and I'm going to write 1,000. And let's just copy this forward. So now our net income under each month is only $1,000. Now under the balance sheet, remember, we received that $12,000. So we need to show that as a deferred revenue account over here. So I'm going to just write 12,000. But here's the deal. This deferred revenue account should be decreased each month as we actually earn our income. So in the very first month, in January, we're going to take this 12,000 and minus 1,000 in earned income. Or rather, let's just minus the amount shown over here. Perfect. Now I'm going to take in the next month this 11,000 and I'll subtract out whatever we're recording in income for that month. I'll then copy and paste this forward, and you can see that my balance now drops to 0. You could also see that my retained earnings by the end of the period equals $12,000. And if I look at what's happening on my statement of cash flows, well, we still have the total cash flows in month 1 of $12,000. The only difference is that our net income is now spread, and the impact to our balance sheet is also spread by the movements in the deferred revenue. So same cash impact, but difference in profit and loss and balance sheet. All right, now let's go to example number 2. In February, the company purchases office desks and chairs for $20,000. The company expects to be able to use these desks and chairs for 10 years. So in this case, we're dealing with a long-term asset, or rather a fixed asset, as it relates to office furniture. So the purchase was made in February for $20,000. So I'm just going to write 20,000 over here. And I am going to bring this balance forward every single month on my balance sheet. Now the accumulated depreciation is going to be tied to my depreciation expense. And as we spoke about, we said that there was a 10-year useful life. So I'm going to take equals 20,000 divided by 10 and then divided by 12 starting in February. So $167 is going to be our depreciation expense. I'm going to drag that forward over here, and you'll see then on the balance sheet that our accumulated depreciation grows by that amount each and every single month. Now on the statement of cash flows, you're going to see the actual payment to the company that we purchased the furniture from of $20,000. And then the depreciation is a non-cash impact. So it's going to cancel out with our net income over here. And in reality, both under the cash basis and the accrual basis, the same is really the impact. So just like we did last time, I am going to take $20,000 and drag this forward. And then under the accrual basis, I am going to take 20,000 divided by 10 divided by 12. And once again, the accrual basis and cash basis doesn't really impact any difference in this example. But one other important note on this, you'll notice that this affects our cash from investing activities. Once again, this is a capital expenditure. This is going to allow the business to benefit from this purchase in the long term. All right, example number 3, the company uses legal services in March, but the bill arrives and is paid in April. The lawyers track 10 hours of work at $300 an hour. All right, so now under the cash basis of accounting, we actually paid that invoice in April, which is all we care about. So in April, I'm just gonna write equals 300 times 10 hours. So you'll see that my balance sheet isn't really impacted other than the hit to our retained earnings. And then my statement of cash flows will showcase the actual cash movement because of my net income account in April. Under the accrual basis, we actually care about when we consume that expense, which in this case is going to be March. So for that reason, I'm going to write equals 300 times 10 hours in March. Now, watch what I'm going to do on the balance sheet. Now, remember, we didn't actually pay that bill until April, but we consumed it in March. So for that, I'll need to record an accrued expense. So I'm just going to come to this line that says credit cards and change it to, say, accrued expenses. And I am going to showcase a $3,000 accrued expense over here. And then I will, instead of dragging it forward, make that amount equal to 0 for every month going forward. So now let's take a look at how exactly our cash flows is impacted under this example. So in March, we have the $3,000 hit to our net income because we consumed that expense. We also have the increase in this account called accrued expenses for $3,000. This cancels out to 0, which showcases that we had a 0 cash impact. When it then reverses in April, because we don't have any other activity, this reversal shows us that we have a negative $3,000 impact to our cash flows. So once again, the actual cash movements is negative $3,000 in April under both approaches. Only under our cash basis, it goes directly from our income statement. Under the accrual basis, it comes from the combination of the activity in our income statement and balance sheet. Okay, example number 4. The company placed a $20,000 inventory order in March, and the inventory was delivered in the same month. The company paid $14,000 to the manufacturer immediately, and the remaining balance was paid in April. All right, so starting with the cash basis, we're not really going to touch the income statement because we haven't actually sold that inventory yet, but the balance sheet is going to be affected. And in this case, we paid $14,000 in March, so I'm just going to write $14,000 over here. And let's just drag this amount forward. And then the remainder of the $20,000 was paid in April. So I'm just going to write equals this plus $6,000. So as of April, we have $20,000 in inventory. And if I look at the cash flows, you'll see that my inventory caused a reduction in my cash of $14,000 and then another reduction of the cash of $6,000 in April. So under the accrual basis of accounting, it's going to be a little bit different. In this example, we actually received the full inventory in March. So I'm going to write 20,000 over here, and I will just make each month equal to that 20,000. Now the difference is the fact that we only paid 14,000 of that amount in March. So for that reason, we have a $6,000 payable in March. So I'm just going to write 6,000 over here, and then the payable goes down to 0. So let's now take a look at our cash flow statement and see how exactly that's affected. Well, once again, we have total cash flows of $14,000 in March and $6,000 in April. But this time, it's because of the combination of our movements in inventory as well as accounts payable between March and April. And finally, the company signs a $60,000 lease for their office on June 15th for the upcoming year. They pay the full amount upfront. So under the cash basis, we are going to showcase a $60,000 expense to general and administrative. We don't really have any balance sheet activity. And you can see on the cash flows that because our net income had negative $60,000 in June, we have negative cash flows of $60,000. Under the accrual basis, once again, we really care about what we're consuming. So because of that, I'm going to record in June equals 60,000. And I'm going to divide that by 12, and I'll continue dragging that amount forward. Then under the balance sheet, we actually have what's known as a prepaid expense. That's because we paid for something that we haven't yet actually incurred or consumed. So for that reason, I'm going to showcase the prepaid expense of equaling $60,000 minus the amount that we put on our income statement for $5,000 as such. Then every single month, I'm going to take this amount and I'm going to subtract out, once again, the actual amount from G&A. So let's now take a look at what exactly happens with our cash flows. Well, like we spoke about earlier, the actual cash flows under both scenarios should net to negative $60,000 in June 2025 when we actually had that money leave our bank account. But in this example, we're showcasing how that relates to actually $5,000 in expenses we consumed, and then the net change in our prepaid expenses counteracts that, which allows us to get to the same point. Now, you'll notice that prepaid expenses is actually very similar to deferred revenue. In fact, it's just two sides of the same coin. For one company, it's deferred revenue. For another, it's a prepaid expense. Way to go! You're now a financial statements pro.